who needs to take RMDs from their retirement accounts. Imagine your retirement savings as a well-tended garden. Once you turn a certain age, the government expects you to start harvesting a little each year. That's what required minimum distributions are all about. They are the minimum amounts you must withdraw annually from certain retirement accounts once you reach age 73. If you don't take out enough, the IRS can impose a hefty penalty of 25% of the amount you should have withdrawn. So, knowing who needs to take these distributions is key to keeping your retirement plan on track. If you own a traditional individual retirement account, or IRA, or have an employer-sponsored plan like a 401(k), 403(b), or 457(b), you are required to start taking RMDs at age 73. This rule applies whether you are still working or already retired. There's an exception if you are still employed and have assets in your current employer's retirement plan. In that case, you might be able to delay RMDs from that specific account until April 1st of the year after you retire, but only if your plan allows it. The first RMD must be taken by April 1st of the year after you turn 73. For example, if you turn 73 in 2024, your first RMD is due by April 1st, 2025. After that, you need to withdraw each year by December 31st. The amount is calculated based on your account balance as of December 31st of the previous year, divided by a life expectancy factor published by the IRS. This means your RMD can change each year depending on your age and the size of your account. Roth individual retirement accounts are a different story. You do not need to take RMDs from Roth IRAs during your lifetime. This is a big advantage for many savers, as it allows your money to grow tax-free for longer. However, if you inherit a Roth IRA from someone else, you might be required to take RMDs as a beneficiary. Inheriting a retirement account can bring additional rules. Non-spouse beneficiaries generally need to withdraw the entire account within 10 years of the original owner's death. If the original owner had already been taking RMDs, you will need to continue doing so during that period. Calculating your RMD is straightforward but important. You take your December 31st account balance from the previous year and divide it by a life expectancy factor from the IRS tables. If your spouse is your sole beneficiary and is more than 10 years younger, you might use a different table that results in smaller RMDs. You have some flexibility in how you take your RMD. You can withdraw the full amount at once or in smaller installments throughout the year. If you have multiple traditional IRAs, you can calculate the RMD for each but can take the total from one or more accounts. You can also withdraw more than the minimum if you wish. Any extra amount counts toward your RMD for that year. Missing your RMD can lead to serious penalties. The IRS imposes a 25% penalty on the amount you should have withdrawn but did not. This penalty can be reduced to 10% if you correct the mistake quickly. So, it's vital to set reminders and make sure you take your RMD by December 31st each year. Managing your RMDs wisely can help you keep your retirement income flowing smoothly. You might reinvest your distributions in taxable accounts or make charitable donations through qualified charitable distributions, which are not taxed and count toward your RMD. Understanding these rules helps you plan your retirement income and avoid unnecessary penalties while making the most of your savings.